Authority.
25 seconds away from the opening bell, coming off the back of the best week of gains on the S&P 500 since the middle of June. Futures right now negative by 0.1%. On the Nasdaq down about 0.2%, with Fed rate hikes seemingly on ice. More data still to come before we get to the 20th. The 13th is your next CPI report. As your opening bell, switch to the board and get to the bond market. Yields look like this in the Treasury market right now. Yields higher by 4 basis points, 4.22. Dollar stronger. The euro down to 107.45. We're negative by 0.5%. The lowest, the weakest euro, going back to about June. The rally in the commodity market getting everybody's attention. It is day 6 for Brent crude. It is day 8 for WTI. Brent crude is up by a couple of percentage points and through 90 for the first time going back to November. For WTI, longest winning streak going back to the start of this year. WTI crude $87 and about 20 cents. We're high here by 2%. That's the cross asset price action at the moment. We need to look at one thing. ARM, one of the most anticipated stock listings of the year so far, downsizing its IPO and now planning to raise as much as $4.87 billion in what would still be the biggest IPO of 2023. Ed Ludlow has more. Morning, Ed.
Yeah, good morning, Jonathan. According to the Form F1, ARM will offer $95.5 million shares, 955.5 million shares in the form of American Depository Receipts, or ADRs, priced currently in a range of $47 to $51 each. As you said, that would see them raise $4.87 billion. Even at the bottom end of that range, if they price at $47 a share, it would still make this the biggest IPO globally of the year, surpassing Johnson & Johnson's consumer health spin-off of Kenvue. You'll remember that came in raising $4.37 billion. A lot of interest here, partly because we see it as a kind of starting gun for the IPO window for technology companies. There are a number waiting in the wings, as you know. Previously, we believed that ARM wanted to raise between $8 and $10 billion at a much higher valuation, say $60 to $70 billion. But what happened or transpired was SoftBank acquired the 25% stake of ARM that the Vision Fund held. And we know that all told after the transaction, SoftBank will still control 90% of the shares, which is an interesting dynamic given the kind of big name cornerstone or anchor investors that are on this deal, which include Apple, Nvidia, AMD, Alphabet, Intel, among others that Bloomberg's reported, but certainly one that we're watching very closely.
Ed, let's make it really simple. So they're going to raise potentially half of what they hoped to raise only a few weeks ago. In terms of the valuation, it might be in the 50s. They were hoping it would be closer to 70, at least in the 60s. And is that a SoftBank problem or a broader market story?
I think a mechanical problem, you know, it's by virtue of the transaction that SoftBank's done. I think, like, even based on the math that Bloomberg's done, at the top end of the range, $51 a share, it will have a valuation of $54.5 billion. You know, part of the psychology of this whole IPO situation and ARM going first is a lot of names that are waiting in the wings, want to see how it's going. But ARM, like everyone else, and SoftBank, by virtue of holding 90% of the company, wants to leave a little room for upside. That's what I keep hearing from bankers and sources that I speak to in the tech industry. And remember, ARM aside, a lot of these companies went through painful down rounds over the last 18 months, but with the longer term goal of going public and having some potential upside out of that being the motivating factor.
Just set the bar a little bit lower. Ed, thanks for the update.
Exactly,
Thank you, buddy. 3 minutes into the session right now, negative 0.1% on the S&P, pulling back just a touch on the Nasdaq by 0.4. Let's stick with the tech sector. Barclays upgrading Oracle to overweight with a street high price target. The analyst writing this, we see a multi-year opportunity for solid growth at high margins, partly fueled by emerging AI workloads, which will be the key to the overall story. Isabel Lee has more. Hey, Isabel.
Hey, John, and that price target is now one of the highest in the street, from 150 to 150 from 124, and 150 is a 24% increase from Friday's close. Barclays sees scope for strong growth at high margins, and that's supported by Oracle's software as a service and its cloud infrastructure, both of which it said can outweigh lower growth parts of the business. And just last week, UBS also upgraded Oracle to to 140. UBS is also citing the cloud infrastructure as well as the GPU capacity of Oracle. AI really seems to be the theme of the year, John. And recall in March, NVIDIA extended its collaboration with Oracle, also in relation with its cloud infrastructure. And as UBS said, the AI story still has a lot of room to play out. Oracle is now up some 50% year to date, John.
And up about 0.4% this morning. Isabel, thanks for the update. Thank you. I want to turn to some new names potentially on the S&P 500. Both Blackstone and Airbnb will join the index prior to the opening bell on September 18th, replacing Lincoln National and Newell Brand. Simone Foxman on top of that one. Hey, Simone.
Yeah, this is a long time coming for both of these names, which have multiple share classes. And that was something that wasn't able to be allowed. You couldn't be in the S&P 500 index if you had multiple share classes until the S&P Dow Jones repealed this rule back in April. So just to recap, to qualify, you have to be a highly liquid U.S. firm. You have to have a market cap of at least $14.5 billion, and you have to meet certain metrics of profitability, liquidity, and share float standards. Now, Blackstone will become the first alternative asset manager to ever be included in the S&P 500 index. This despite the fact that it went public back in 2007. But after they dropped the rule, both Airbnb and Blackstone seen as benefiting here. And of course, this despite some unfavorable rules that come into effect for Airbnb today. We can see the impact on the shares, rallying 3%, over 3% for Blackstone, over 7% for Airbnb. John.
Simone, thank you. 5 or 6 minutes into the session, your update right now, negative 0.2% on the S&P. No drama there. On the NASDAQ, down by 0.4. Now, I'm not sure what would make you more miserable, being a Manchester United fan over the weekend or holding the stock this morning. I'm looking at my floor manager right now, who is a Manchester United fan. Stick with me. The stock is down by about 11.4%, 5 minutes into the session, as Man United may be taken off the market after the Daily Mail reported that the Glazer family isn't getting offers matching their asking price, writing, quote, "The Glazers are thick-skinned and won't be influenced by any negative fan reactions." Katie has more. Hey, Katie.
Hey, John. Yeah, you take a look at shares this morning, currently off by 11.5% after the report in the Daily Mail over the weekend. According to sources, the Glazer family, that thick-skinned family, they originally hoped to attract multiple serious bidders here, but only ended up with two. We're talking about Sheikh Jassim of Qatar and Jim Ratcliffe. Now, the Glazer family reportedly taking the team off the market. They're going to try again in 2025 when hopefully improved conditions will attract more bidders. And the Glazer family is looking to sell the team for between 7 to 10 billion euros at that time. Again, according to Daily Mail sources, as of Friday's close, you look at the market, Manchester United valued at $3.9 billion or about 3.6 billion euro. Now, it's worth noting here that when contacted by Bloomberg, a team spokesperson declined to comment on, quote, rumors and speculation. But even still, you can see the drama playing out in the stock market. Shares now off by 11.7%. If that holds, John, it'll be the worst day since February.
Did they comment on the Arsenal game? Kelly, that's what we all want to know.
I barely know what we're talking about here, John, but I'm not sure.
We appreciate your honesty. Katie, thank you. On top of the stock, more than the game over the weekend. Would you like to talk about? No, don't want to talk about the Arsenal. No? Okay. Goldman Sachs cutting its US recession odds down to 15% from 20, writing this. Real disposable income looks set to reaccelerate next year on the back of continued solid job growth and rising real wages. We still strongly disagree with the notion that the long and variable lags of monetary policy will push this economy towards recession. PIMCO's Tiffany Wilding offering her own assessment after Friday's payrolls data, writing the following. This was a Goldilocks report for the Fed. Labour markets are calling but not falling off a cliff, and the slowing is likely to continue as the economy faces various headwinds in the second half of 2023. I'm pleased to say that PIMCO's Tiffany Wilding joins us now for more. Tiffany, let's start there. The kind of slowing that you're expecting into year end for some really phenomenal numbers we're seeing in the third quarter.
Yeah, well, certainly consumption has been the standout this year. The consumer has been very strong, and that's pretty aberrant from historical hiking cycles. You do tend to see more moderation in consumption as labor markets slow. We're just really not seeing that. Consumption in the third quarter looks like it's running above 2.5. Obviously, GDP tracking reports also look like they're closer to 3. So this is an economy that just doesn't seem to want to quit. Now, nevertheless, though, we are seeing indicators, higher higher frequency indicators that would suggest that things are slowing. So we have student loan repayments that are starting. Treasury daily data suggests that people are actually prepaying that, and at the same time they're spending less. So high frequency data from credit cards suggests that we are seeing consumers that are starting to pull back. Add to that, that you have seen much less credit creation overall for the economy this year, and that is a recipe for slowing. Now whether it actually pulls us into a recession or not, I think that's more of a question mark here, just because of the ongoing resilience in the U.S. economy.
Well, do you see us on a path towards returning inflation to 2%? Are you confident we're on that path, Tiffany?
Yeah, well, we're certainly going to get some good news on the inflation front in the back half of this year. But really that good news is centered around some of the pandemic-related effects just fading. Of course, things in China have been much weaker than expected. They are, as a result, exporting some disinflation. That's going to help U.S. retail goods prices going into the holiday season, which many consumers will be happy about. But nevertheless, other measures of inflation, wages, for example, in the United States, they still look sticky. This super core measure that the Fed loves, services ex shelter within the PCE inflation measure, also still looks relatively elevated. So one of the things that we've been noting, and this is consistent with the Fed's forecast, is that you do need to see some labor market cooling in order to get that down. And I think it's a question on whether we'll see some labor market cooling just because the economy's been so strong.
That's the labor market, throw in housing as well. Tiffany, we could look at commodities too. Can I just get a comment, Tiffany, potentially from you on whether this commodity market move complicates the Fed's effort with Brent, WTI back in and around $90 a barrel?
Yeah, well, certainly, headline inflation matters. It matters for how consumers think about future inflation and inflation expectations. But on the other side of that, it also matters because higher gas prices will affect consumers' ability to spend on other discretionary items. So it's a little bit of a mixed bag in terms of how it affects the economy. We still, in terms of the underlying inflationary pressures, we like to look at core inflation. And again, that's going to look a lot better in the second half of this year, with some risk, though, that maybe it reaccelerates if the economy doesn't cool.
So Tiffany, when we get forecasts next up from the Federal Reserve, how do you think they'll compare to the last set of forecasts we got earlier this summer?
Yeah, so they're going to be a bit of a mixed bag in terms of their implications for the rate path. So we do think Federal Reserve officials will have to revise down their core PCE inflation forecast, at least for the end of this year. But at the same time, they're probably going to be revising up their growth forecast, and there's been some good news on the labor market front. They could have to revise down their unemployment rate forecast. So all of that, sort of suggests, maybe they keep that rate hike in the back half of this year, maybe they don't. But this is coming up in September. We would also argue there's a lot more data between now and the end of this year for them to think about. And I guess overall, just looking out to 2024, if the economy is not cooling, if we are still running at above trend growth, if the labor market, the unemployment rate is still at these levels, kind of 3.5 to 3.8, it's possible the Fed might even have to do more. So I think that's something that that we're grappling with. Not our base case certainly, but
sure.
Something that's the risk that's out there.
Well, let's take it one step further. Let's play what if for 2024. Tiffany, are you still of the opinion that, let's say inflation is 2 point something, that they won't be willing to do anything about it? They won't be willing to crush the economy or the labor market. They'll just tolerate 2 point something.
Yeah, certainly. I think if it's a two-handle, that's probably good for the Fed. But I do think there's questions around if the labor market remains this tight. It could stay around 3, which is a little bit more cuspy. Yeah, but overall, I think there is a question around if you get it down to 2.5, let's say, and you continue to forecast it moving lower over the next few years, then maybe that is all you need to do. And that would be very similar to what the Fed did in the 90s with their opportunistic disinflationary strategy. And I would say if you look at economic performance in the 90s, it was pretty good. And overall, 2 is really not, it's not a magic number, if you will. It's, 2% inflation, that there's not a lot of cost benefit analysis around 2 versus 3 versus, price stability in terms of their target. Nevertheless, though, as Chair Powell said, they're probably not going to change their inflation target, but they could alter their strategy within that target, to let it go a little bit above for a period of time.
Tiffany, thanks for the update. As always, one of the best. Tiffany Wilding there at PIMCO. on the look ahead for 2023 and 2024 as well. This just in from Anne-Marie. AMH wants you all to know that that Man U goal was offside over the weekend, for whatever that's worth. 14 minutes into the session, your equity market slightly negative on the S&P. Coming up, China's big breakthrough.
China has been catching up over the past several years, pouring lots and lots of state subsidies into its industry. So the second prong of the strategy, holding China back, has taken on more prominence in recent years.
AMH and Ed Ludlow, your team coverage up next.
China has been catching up over the past several years, pouring lots and lots of state subsidies into its industry, and that's why the U.S., Japan, and the Netherlands in particular have tightened up their export controls on chip-making tools, which now can no longer be transferred to China to help China produce cutting-edge chips. And so this second prong of the strategy, holding China back, has taken on more prominence in recent years.
Chris Miller there of Tufts University weighing in on China's chip race as the US-China tech war heats up. A major breakthrough in the last week, a teardown of Huawei's newest smartphone, revealing an advanced 7-nanometer processor, a sign Beijing is making progress in a nationwide push to circumvent US sanctions. Your team coverage starts right now with Bloomberg's Anne-Marie and Ed Ludlow. Ed, just how big of a breakthrough was this for China?
Well, in layman's terms, this is the best ever made in China chip. That's the easiest way to understand it. 7 nanometer nodes are, for China, where they're at in chip manufacturing. You'll remember on the show a week ago, Jonathan, there were local media reports and speculation that the processor in the Mate 60 Pro might be 5 nanometer. And that was very surprising because broadly the industry does not think China has got to that stage. What the teardown that you're looking at right now, and actually any second you will see the processor known as the Kirin 9000S processor confirms, is that it is 7 nanometer. That is 2 generations removed from the cutting edge, which is 3 nanometer. But what's so important is that Semiconductor Manufacturing International, and you're looking at the Kirin right now, that is the processor. But what is so important about Semiconductor Manufacturing International, or SMIC as it's known, it's China's leading chip maker, but the US technology curbs apply to their supply chain. So we asked the Commerce Department, hey, this 7 nanometer, is it bound by the existing curbs? And they haven't responded. It's fascinating.
Interesting. AMH, if this is a massive win for China, how big a loss is it for this White House?
Well, Jonathan, just look at the timing of all of this. This Huawei new phone came out at the same time as you had Gina Raimondo leaving China. She was there to try to put some more formal engagement in the dialogue between Washington and Beijing that really has deteriorated in the last few years. And now a big question, I think, facing this administration is that are these sanctions, these export controls to try to stem China away from that high advanced U.S. technology, are they effective? Are they adequate? That is something this administration will be asking. But it was a triumphant in China when you have the Global Daily Times putting out a political cartoon where Huawei is seen as a vehicle, car on the road, busting through a blockade, trying to stop cars from coming in and saying that they are basically free from these U.S. sanctions controls and export controls. So this topic is certainly not going to be going anywhere anytime soon, but I would say it's up to the viewers to decide whether or not they thought it was a coincidence that this phone was released as the Commerce Secretary, the agency that is in charge of these sanctions, she was on her way out.
Well, AMH, I'd go one step further. The unveiling was so quiet, and it came at a time when they had someone from the outside preaching to them about why their economy may well be, quote, uninvestable. Isn't that somewhat embarrassing now for the Commerce Secretary to be preaching things like that at a time when they've been able to unveil something like this?
Well, what the Commerce Secretary was talking about is what U.S. companies are saying about China. What we've seen in China, and Reuters reported this weekend about their fund, they're putting another $40 billion into it so that they have their own domestic production of these chips to make sure that they still are remaining competitive with the United States.
Quite a breakthrough in the last week. Ed Ludlow, AMH, thank you to the both of you. About 22 minutes into the session, we look like this. We're down by 0.36% on the S&P. On the Nasdaq, we're down by 0.38. No drama. Let's get you some sector price action. Here's Simone Foxman.
Yeah, just about every sector in the red this morning, with the exception of energy. Industrials, the weakest today, led by losses in part in airlines. Airlines have had a terrible August, down 9.5% last month. Transportation companies as well feeling the pain. But September tends to be the weakest month of the year over the past 30 years, seen an average change of down 0.7% in the month, so not setting us up well. We are looking at communication services trying to eke out some gains there. Where we are seeing some upside is the energy sector. Saudis prolonging voluntary oil production cuts for 3 months. It was anticipated that they would prolong these cuts, but 3 months is quite a long time. Russia joining in, and we're seeing the benefit to the major international energy companies, Exxon, ConocoPhillips, even Chevron, which is dealing with some labor concerns in Australia around potential strikes, up now more than 1% in today's trading. John?
Simone, thank you. If you are just tuning in, that has been the news of the last hour or so, the last 50 minutes, the developments with Saudi Arabia and Russia. That move on Brent crude up by 1.3%, $90 a barrel for the first time since November. On WTI crude, about 87, up by 1.9% this morning. That's the crude action. Coming up, your trading diary. 25 minutes into the session, starting the week a little bit lower, soft and negative, down by, let's call it a third of 1% on the S&P 500. Underperformance on the Russell, the small caps down here by 1.8%. That's equities. Let's take a look at bonds. The bond market right now shaping up as follows. 2-year, 10-year, 30-year yields creeping higher off the back of another rally in crude this morning. We're up by 6 basis points on a 10-year, back to about 424 on a 30-year, further out along the curve, up by 7 basis points to about 436, which incidentally was the high of the year for the 10-year yield in the last couple of weeks. That's the price action. Let's get to the trading diary. The week ahead looks like this. U.S. factory orders and durable goods coming at the top of the hour. The Fed releasing the beige book on Wednesday, plus Fed speak, Collins, Logan, followed by Williams, Bostic and Harker on Thursday. Another round of jobless claims on Thursday as well. And we round out the week all coming ahead of the G20 summit kicking off on Saturday. From New York, that does it for me. Thank you for choosing Bloomberg TV. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day, Tuesday, September 5th. Here are the top market stories that we're following for you at this hour. The problem with stocks. Morgan Stanley's Mike Wilson says there's too much optimism priced into the equity market and breadth is still weak. And the problem with autos. hurt by a weak China, more competition, and a potential worker strike in the U.S. We're going to see what it will take for the stock to shift gears. And the problem with oil. Russia, Saudis extend oil cuts to the end of the year. Brent tops 90 for the first time since November. From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. Guy, it's been a pleasure. I love the tan. You look great. It's so nice to see you back. We missed you.
So I'm back from Greece, where it is now raining, and it is now very hot in London. So I feel I'm doing something right now.
Good for you. And you made it on vacation through the strikes, through the delays.
Precisely. I think the story with strikes around the auto sector and the strikes around what is happening with the airline sector, I think they're kind of in some ways synonymous. These are industries that have pushed back really hard on their staff over a number of years, and maybe they're now paying the price for that. We've got some data coming in. Let's talk about that as well. We're going into quiet periods for the Fed at the end of this week. We've got the ECB coming up next week. The numbers really matter right now. Factory orders out of the States come in negative 2.1. That's slightly better than anticipated. Ex-transport, they come in better than anticipated, actually. In durable goods, negative 5.2. That's bang in line with expectations. Ex-transport, they come in at 0.4. So, Alex, the numbers look all right. Certainly the durable goods numbers kind of are bang in line. They could have been worse. The factory orders numbers look all right as well. I think the market's not going to react too much to these kinds of numbers. The oil story, though, is a different matter. I think this is going to really start creeping into the inflation data, and I think a lot of people have been talking about the fact that inflation is just going to come down sequentially. I think with higher oil prices and higher for longer oil prices, that may be now being called into question.
Yeah, and then you wrap in potential strikes in many different industries, right? And then are you looking at then wage pressures being filtered through, and that's a higher for longer inflation expectation environment as well. I mean, oil at 90 isn't good, and I gotta say, for the administration here in the U.S., there's literally nothing that they can do. They got nothing to combat this.
No, I guess you could continue to maybe take some oil out of the SPR. Maybe you go back to that, but that feels like it's a bit of a busted flush. There's not much there's not much, and there's not as much there to do on that front. So yeah, no, I think it's going to be interesting. But I think it's going to be something that around the world people are going to pay attention to. I have to say, filled up the car the other day, definite sticker shock in terms of where prices are. They are high. And that takes us to our question of the day, which you alluded to at the top of the day as well. What is happening with the auto sector right now? I think it's an interesting story post-Labor Day. We need to be talking about that strike story. We need to be talking about what is happening with the energy story as well and what that's going to mean. European autos are having a really tough time. You've got the auto show taking place in Munich. You've got the German Chancellor, Olaf Scholz, the pirate as they're calling him now. We'll talk about that in the next hour as well, saying that they shouldn't be afraid, the Europeans, of the Asians. But this is a sector that can't get into gear. Let's talk about it. Craig Trudell joining us on the auto side. Nur Al-Ali of Bloomberg M Live joining us as well. Craig, I'm going to start with you. The European car makers, they're facing a challenge from China. They've got Chinese data that is slowing down. The US automakers have got a more immediate kind of threat that they need to deal with, this strike issue. Let's talk about post-Labor Day. Let's talk about how big a threat that actually is.
Yeah, I think with GM, Ford, and Stellantis, they have had the luxury of the last, maybe call it 6 months of being able to produce like they were accustomed to prior to the pandemic. And it really took that long for them to work their way through the semiconductor shortage. And so they've maybe been able to build up a bit of inventory. If anything, we've actually started to hear, some overshooting, and maybe that will come in handy if we do have a walkout, I think.
Do you think we're going to have a strike?
I think the way the rhetoric is coming out of the mouths of the United Auto Workers Union, it feels like an inevitability at this point.
Okay, Nor, can you talk me through the potential downside here to some of the equities based on that? I mean, I appreciate that they've been raking in the profits the last few years, right? But still, they have to make this big shift from ICE to EVs profitably and then facing down a double-digit wage increase.
Yeah, absolutely. And that's partly why the Biden administration actually extended some funding to those automakers so they can actually, that can aid them in their EV transition. And, just mind you, these strikes, these labor talks are about those fears from those workers that are worried about their jobs, coming into that transition. So they are asking for those higher wages to come in as well. And that feeds into the wider story. And if you look actually to compare this, and this is an excellent analysis by some of my colleagues on the blog, you'll see that in fact automakers in the U.S. have actually underperformed discretionary stocks because there's just so much that's in the fray here. They've got higher production costs, obviously relative to the Chinese that are taking up a much larger portion of the industry, and obviously there's been a lot of concern as well. They're projected to increase their dominance of that industry, and they have lower costs there in China by about 25% as well.
No, the thing that I don't really understand is why would you want to own a US auto stock? I know they've had a good time recently, but they're going to have to pay the price for that now. When you can own Tesla, Tesla is clearly out there to make some market share. Tesla is cutting prices, it's coming out with new brands, it doesn't have the legacy issue. Why would you want to own a US auto company when you can own Tesla?
Why wouldn't you, right? I mean, there's a lot of diversification involved here, right? So automakers in the U.S. currently, you know, they are legacy companies, but they have also performed relatively, I would say, well. So if you look at some analysis through the port function, you'll see, for instance, that Ford and, for instance, General Motors, you know, really underperformed relative to total returns, relative to the total index. So potentially there is some appeal here. If they were to weather those, those strikes in the short term, there's potentially some appeal here in terms of valuations. And there's a lot of optimism currently baked into the U.S. stock market, and this is another issue here. Of course, a lot, you know, there's almost shifting gears here. Larger voices in the market are now pointing to a softer landing in the U.S., and so that's going to point to, you know, better manufacturing. And where would you go? You'd go to those automakers that you typically know.
Yeah, you know what hurts manufacturing costs, though? Higher oil prices. And Guy, this is where I feel like everything is interconnecting with us today, because on the one hand you have potentially higher wages, you have issues there, then you have higher oil prices, and all of that winds up feeding into potentially inflation scenario. And it also points to sort of the messiness of the transition that the whole world's going to be underway as we go to green, right? If
absolutely, but you've got to also point
that's more expensive.
They do, but you do wonder whether that messiness, whether that inflationary impulse is being aided and abetted by Joe Biden's Inflation Reduction Act. That is something, you look at what the UAW is saying. They're in the driver's seat, to excuse the pun, right now. Biden has basically said, you need to build these cars in the United States. They're like, great, fantastic. That's going to be good for our staff. We're going to make sure that they benefit from that as well. Craig, isn't that the issue here? Joe Biden's basically set a trap for himself.
Yeah, I think it's tricky because, you know, you have a situation where a lot of the battery plants that are going in the U.S. As a result of the IRA are going down in the South. The UAW has had a heck of a time, as we know, for decades now, organizing plants that they haven't already represented. So, you know, what sort of, you know, what can they sort of bring to the table to convince what are in the end joint venture companies, you know, GM, Ford, Stellantis, they have joint ventures with foreign companies who have very little interest in seeing their labor costs go up. What can they do to sort of, you know, bring these companies to the table and convince them that, you know what, unionization is a good idea here, when we know that, you know, the Hyundais of the world, Toyotas, not to mention Tesla, you know, are not going to, you know, be organized anytime soon. The UAW has had a weak hand to play for some time.
So this leads us to the question, Nor, is the market in general underestimating higher yields, wrapping it all in?
Yeah, absolutely. And I think that's a big part of it. We've been talking on MLive about how inflation really is about to resurge. And we're seeing different aspects of it really narrate itself in different facets. You talked about oil. You know, that's led by, you know, Saudi Arabia, Russia extending their production cuts. Surprisingly, Saudi Arabia, till the end of the year, they were expected to extend them by 1 month. You know, these rising yields potentially point to the Fed, if not, not raising rates anymore, at the very least keeping those tightening efforts on for much longer than the market anticipates. You look at money markets and they're expecting Fed to start cutting sometime within the next year, and that's not really translating into the different aspects of the economy. If you're looking at commodities, they're resurging. You're seeing a lot of concerns here, and that's translating to some complacency, particularly in the U.S. stock market.
Such a fun way to set the conversation, guys. Really appreciate it. Craig Trudell of Bloomberg and Noor Ali of Bloomberg MLive. Thank you. thank you very much. So coming up, more insight into the question of the day. Why is the auto sector running on empty? And then we're going to lead that into the inflation and yield conversation with Subhadra Rajappa, SocGen head of U.S. Rate Strategy, joins us next. And as we head to break, let's hear what Acting Labor Secretary Julie Su said about the impending auto strike. I spoke with her last Friday after the jobs report.
We remain hopeful that the parties will resolve their issues. We trust the process to do that. Obviously, strike is a part of that too, and everybody would love to see a path forward where the union and the employers do the right thing. These are a moment in which union members are seeing historic profits coming out from a pandemic. So I think that the parties have to remain talking.
This situation is really scary for a number of reasons. First, you have a very, very activist new UAW leader who has said very, very inflammatory things that is just beyond the pale in terms of any auto company's ability to meet it.
That was Steve Ratner, Willett Advisors Chair and CEO, talking to Wall Street Week's David Weston on the UAW strike. Remember that Ratner led the bailout of the U.S. auto industry during the crisis in 2008-2009. So that brings us to the question of the day. Why is the auto sector running on empty? Joining us now to discuss is Subhadra Rajappa, SocGen head of U.S. Rates Strategy. Subhadra, I know that you're a rates person, not a car analyst, but I feel like all of these stories sort of intersect, right? You have potential recessionary fears if you wind up having a full strike. On the other hand, 42%, 46% increase in wages, that's a wage inflationary scenario, and higher oil prices. How do you wrap all that into your thinking about the bond market?
It's very difficult, Alex, because this is a moving target. We've had several strikes, UPS and others. We've had, issues with the trucking company. So it's really, really hard to gauge what the labor dynamics are going to be over the longer run. We know that wages have been high and sticky. We haven't really seen a precipitous rise in wages. But broadly speaking, a combination of both higher oil prices as well as pressure on the labor markets, a very tight labor force, is going to continue to put some pressure on inflation. Yep. That's kind of where we're trying to gauge how much of an impact this is all going to have on the rates markets.
Subhadra, Good morning, it's Guy. The savings are coming down pretty sharply in the US. Spending has held up as that money has been spent. What kind of a wage story are we going to need to see to keep the consumer on track, do you think?
So it's, wages are running, between 4 and 4.5%. It's kind of stayed there. We haven't really seen an uptick. I mean, it's clear that, labor has a lot more bargaining power. They've been able to, win a lot of the concessions and higher wages in some of these negotiations. But broadly speaking, if you look at, the broader spectrum, you are seeing the economy, different parts of the economy perform differently, as you mentioned. The savings rate is coming down. The consumer is coming under a lot of pressure. Student loan moratoriums are going to end at the end of this month. We've seen a splurge in the summer. Is that summer splurge going to last? Unlikely, given the fact that savings rates are low and the consumer is coming under a decent amount of pressure going into the fall.
So with all of that in mind, how do you know what's fair value in the bond market? What should the 10-year be trading at, and how should you then invest?
No, we're definitely recalibrating our expectation for where 10-year yield is going to end at the end of the year. Fair value for 10s is anywhere between 4 to 4.25. I think that given how strong the economy has been, how resilient the consumers have been in the face of higher interest rates, and the Fed is also committed to keeping policy on hold for longer at these very high levels, I think that that's going to keep interest rates at a much higher range than we had anticipated coming into this year.
Okay, let's talk about what's happening at the front end, Subhadra. If the Fed's done, and there's reasonable evidence to suggest that may be the case, if the Fed's done, is the 2-year great value right now? If you've got money in a money market account, you're getting 5%, do you switch into the 2-year, or do you switch further out? Do you go for more duration?
So the 2-year still has, a tremendous amount of value. I think that the Fed could perhaps deliver another 25 basis point hike. It's not going to happen at the September meeting, perhaps at the November meeting, but that basically tells you that 2-year yields are at or close to the peak levels. So, and for the curve, we're looking at perhaps either the 2 cents part of the curve steepening out one way or the other. So for the most part, at least over the near term, it looks to me like the value is going to be in the 2-year, because the 2-year is going to be pegged to Fed expectations. And there's potential perhaps that the 10-year part of the yield curve could rise further. But over the longer run, if we do expect a recession in 2024, yields across the curve are going to be quite attractive on an outright basis, as well as a diversification, given the fact that risky assets are going to come under pressure as we head into a recession.
So Badr, you said that for fair value for the 10-year, you're looking at 4 to 4.25. And we're right at 4.25 now. So if your recession view takes hold for next year, do you need to then buy the 10-year and just sit tight?
Perhaps. It's a question of timing. I mean, if you looked at the first half of the year, you went long 10-year yields. You probably did very well during the regional banking crisis when 10-year yields got down all the way down to 330. Now we're back again near the high end of the range. Could we push higher? Perhaps. Over the very long run, I think yields are probably going to head lower, and this might be one of your better buying opportunities for the longer run.
Subhadra, always great to catch up. Really appreciate the insight as ever. Thank you very much indeed. Subhadra Rajappa, SocGen's head of US rate strategy. Manchester United stock is being pummeled right now. I think it was a Daily Mail, Mail on Sunday article yesterday talking about the fact that the Glaziers might want to keep it. Stock's under real pressure. Okay, still ahead, what are we going to talk about? So we're going to talk about chips. Huawei's latest smartphone succeeds despite US sanctions. They're making some breakthroughs in China. Looks like they're actually managing to sidestep the US sanctions. We'll talk about it next. This is the teardown story. It's definitely worth watching. This is Bloomberg.
is 21 past 7 on the West Coast. We want to get to the startup. We cover the top tech stories from the Bay Area and beyond. As Silicon Valley starts its, I think it looks nice morning. Bloomberg Technology co-host Ed Ludlow joins us now. All right, let's get to Huawei for a second. So they had built an advanced 7-nanometer processor to power its latest smartphone. Yes. And this is significant because this is kind of a slap in the face to the U.S. Look, we don't need you. We can do this on our own.
Yeah, the way we're describing it in layman's terms is this is the best or most powerful made-in-China chip or smartphone chip. It's in the Huawei Mate 60 Pro, which you'll remember was released stealthily last week. And what Bloomberg did is we went to a research firm called Tech Insights, and we said, here is a handset of the Mate 60 Pro. Tear it down for us and see what you find. Lots of emphasis on the processor. So what we know is that it was made on a 7-nanometer node. That's 2 generations removed from the cutting edge, which is 3 nanometer. But there had been speculation last week when this handset hit the market that it was 5 nanometer. And that was a big surprise because the market and industry for semis broadly says, well, to the best of our knowledge, China has not yet got to 5 nanometer. So all this confirms is it is 7 nanometer. It's made by Semi Manufacturing International, or SMIC, which is China's sort of best and biggest chip maker. But they're still not where we are in the United States. The question is any of this caught by sanctions?
Okay, so what's the answer to that question? And is the gap between what is being produced in the United States and what is being produced in China growing or shrinking?
The answer is we don't know because we asked the US Commerce Department that question and they haven't responded. But one thing about SMIC, or Semiconductor Manufacturing International Corp, is that so much of their supply chain is related to and bound by the US technology curbs. Are they shrinking? Is the gap between China and the US shrinking? No, not on this basis. And there are some limitations, right? Jeffries has a note out looking at what we've said, looking at this Mate 60 Pro. The handset sold out within hours. What that tells us is they probably had very small inventory. So they're not just 2 generations behind in chip making in terms of 7-nanometer node versus 3 nanometer, but they're not able to produce it at volume.
Hey, can we turn to NVIDIA for a second? Ed, since we have you, Rob Arnott is a Research Affiliates founder, right? And he had an interesting chat with Bloomberg and talked about how NVIDIA could definitely wind up being in a bubble that's too big to fail, but too big to succeed. And a quote a textbook story of big market delusion. What did you make of this?
I mean, Rob Arnott is known to us as the bubble hunter. That's how he made his name at Research Affiliates LLC. And his point's really simple. The run-up in the stock and its current valuation is us pricing in all of the capex that's going to accelerated computing and the compute needed to train large language models. The run-up is extreme, and so this is has all the hallmarks based on his experience of a bubble, and no one else has seen it yet.
Goldman Sachs differs.
Yeah, so Peter Oppenheimer, strategist crew, has a note out saying, AI valuations are high, but they are not extreme, quote. And you know, his logic is this, that because the run-up is not outside the bounds of what they consider at Goldman to be extreme, the inference they're drawing is that we're really early in this cycle of hyperscalers and others committing capex to develop compute for AI and other large language models, and that we will continue to see that expansion and investment, which will continue to push up valuations even higher from where they are currently.
All right,
okay.
Yeah.
I think we got it. It could be a bubble, it might not be a bubble. Who knows at this point?
Time will tell. Time will tell.
I think it's one of those things, like recessions, isn't it? You can only tell them retrospectively.
I've not lived through or worked through a bubble. If there is one, it will be my first bubble, and I'm looking forward to it either way.
Something to look forward to, Ed. They are certainly, having lived through a few, they are certainly entertaining. Let me put it that way. The run-up to 2000, I remember it. I remember being in a bar in the Berkeley Hotel, and this technology analyst just kind of ranting in my ear about how the world was being changed and this stuff was going to the moon and the valuations were crazy, but actually could be justified.
That's where you got the gray hair. You got to get the gray hair.
But I don't get to go to the bar this time, which is disappointing. It's the blue bar in the bar. It was lovely.
Yeah.
Excellent.
Ed, you can have that experience. You should go to a really nice bar, and I'm sure it'll be populated with those kinds of people. Ed Ludlow, thank you very much indeed.
I will.
Alex, I just want to take a quick look. Ed might want to chime in on this one as well. Manchester United stock being absolutely pummeled right now. I think there was an article in the Mail on Sunday yesterday talking about the fact that Glazers may not want to sell. This is what it's doing to the stock. This is a 2-day share price drop, as you can see.
Yeah.
The move is substantial. Alex doesn't want to talk about sports.
No,
this is not. This is M&A. This is not sports.
Yeah, but it's valuation.
Anyway, we're going to get back to the auto sector in just a moment. This is Bloomberg.
We're about an hour into the U.S. trading session. We're finally back from Labor Day. Guys back from vacation. Stock's trading a little heavy, though. Simone is tracking some of those moves. Simone?
Yeah, shares in the red to start the second day of this month's trading sessions in the United States. We're expecting a pretty negative September if the past 30 years of history, though, is any indication. Over the past 30 years, we've averaged down negative 0.7% for the month of September. And certainly today's vibe very much in line with that. The VIX up, shares down. We're watching WeWork here. The company completed a 1-for-40 reverse stock split late last week. So this is the first day it's trading after that split was completed. Of course, this company under a lot of pressure, whether or not it can continue as a going concern, something that has been raised recently. We're seeing shares there fall after that stock split, though. But the major story of the trading session so far has been what's happened in the oil markets. And if we flip up the board, we'll see. The expectation was that we would see Saudi Arabia continue to extend its voluntary production cuts, at least through the month month of October. But the country coming out and saying it will extend them through December. Russia coming out and saying it will extend its export cuts through the end of the year as well. And that's why we're seeing so much interest on the longer dated derivatives. Those in the blue, those are for November. The ones in the white here are for October. And so that's where we're looking at this reaction as we see Brent crude pass $90 a barrel for the first time since last November. And this is, of course, having an impact on some of the big energy names, despite some negative headlines out. For example, Chevron had been fearing the impact of some of those strikes that could potentially happen in Australia, but shares up there over 1.3%. Shares of Exxon, ConocoPhillips, all well in the green, and the S&P Energy Index was, last I checked, the only sector of the S&P that's actually eking out gains today. Alex, Sky.
Simone. Thank you very much indeed. I want to get back and talk more about what's happening in the car sector. Mercedes-Benz is taking on Tesla, unveiling an EV which has got a longer range, get this, than any Tesla model currently on the market. Bloomberg spoke with Mercedes-Benz CEO at the IAA Auto Show yesterday.
Our goal is value over volume. So we're not pushing volume. We're very, very careful about how we go to market, our go-to-market strategy. And as you can see from the results for the first 6 months of this year, that has been working quite well for us. We're focused on value for the customer. I don't think the customer expects from a Mercedes a little bit of a roller coaster ride, but something that you can depend on. So we will continue with the value over volume strategy.
Value over volume. It has certainly been working. That has been the strategy that has basically come out of the chip shortage. Takes us back to our question of the day. That was Ola Hallinus, of course. Why is the auto sector running on empty? You look at the stocks here in Europe, they are super cheap. You look at what is happening in the US, looks like the market kind of doesn't want to buy this sector in advance of potential UAW auto strikes that could be happening really soon. Tom Narayan, I can't believe I can't say that, global auto analyst at RBC Capital Markets. I've said that name about 1,000 times and now it doesn't seem to work in my mouth. I think it may be a vacation brain issue. Tom, I'm really sorry about that. Deepest apologies. You can blame a vacation. The US story, I think, is really fascinating right now. You've got this potential strike coming up. The market's kind of looking really wary around what could happen here. Is this one of these situations where you want to buy the stock now, kind of in the expectation that this strike gets sorted out, or do you want to wait? And if you do wait, how big a pop could we see?
Yeah, I think there could be a very sizable pop here. The issue, though, is it's kind of a chicken and egg thing, right? So if the investor base is waiting for a resolution, that means that it could get worse before it gets better, right? There's going to be a lot of negative headlines in the news around this, right? It's a political gamesmanship on two sides. So do you wait until things get worse and then buy at a better entry point? Or do you just buy now knowing that when this is all resolved, the stocks will move higher? I could see both sides of the argument. Frankly, I think you also have to be choosy a little. I think a name like GM is really well positioned in the U.S. because they take advantage of the IRA on EVs. They have a huge set of launches. Yeah. You could just buy that name now and then take advantage of it later.
Hey, Tom, my question is, though, what do their operating margins look like in the future? Like, yes, I understand the subsidies for EVs. I understand the $12 billion to build EV factories here in the U.S. But then if you look at higher wages or maybe pension reform or 32-hour work weeks, I mean, that is a productivity labor hit for sure.
Yeah, that's no doubt about that. And, everybody's looking at 2019, even ourselves at the last strike, what happened. And what happened was you had higher labor costs. But that got offset by the pandemic, which allowed these car companies to juice up pricing, right? So if pricing falls, price mix falls, that could be a problem because then higher wages don't get masked enough. One caveat I will say, Ford has this on their website. They show the labor costs as a percentage of their total COGS. The impact actually surprisingly isn't as big as some people are fearing. Maybe it's like 100 basis points or 50 to 100 basis points of margin hit, which is nothing to laugh at. But it's not something like a doomsday scenario. It's really more like the cherry on top of price mix coming down that can make things worse. But ultimately, the thing that people are most scared about is price mix coming down, not really wage inflation related to UAW.
Tom, are US automakers more insulated than European automakers to the threat that China poses? The IRA kind of has a whole range of issues built into it that promote US manufactured vehicles. The Chinese clearly are building a lot of EVs right now, and they're doing it cheaply and they're doing it efficiently. Where is the biggest hit going to come? Is it with European automakers from that Chinese threat, or is it US automakers?
Absolutely European automakers. Yeah, I mean, and you have to ask yourself, why isn't there a European IRA? You know, some people say it's because the German OEMs are really exposed to China and dependent on China, and they kind of don't want to anger the Chinese. Other people say it's politicians in Europe who are just, you know, don't like the auto industry. I don't know. But in the U.S., we do know that they're more insulated against Chinese OEMs coming in. In Europe, it is a tough sell. One thing I will say is I think the premium guys in Europe will do better, BMWs and Mercedes. Brand is really important in Europe, as we all know. Mass market guys, there's a reason why Stellantis and Renault have been talking about being more protectionist against the Chinese OEM. So I think mass market folks are going to be more threatened by this threat, and maybe the premium guys less so.
Well, and Guy, to your point, it's just the carrot stick thing. Like the way it's been described is that the U.S. just throws money at the problem first, asks questions later, and Europe asks all the questions, and that may be because that's how their the European Commission, European Union is set up. But that poses a lot of issues when you're trying to move quickly.
Well, the problem is that there's two different. Tom, there's two different car sectors in Europe. As you say, you've got the mass market guys. I remember talking to Sergio Marchionne, and he said that the biggest error the Europeans ever made was letting the Koreans come in, Kia, etc., and it completely undermined their market. And you do wonder whether, in order to protect the high-end guys who are working really well in China, in some ways the Europeans are throwing the mass market guys under the bus, and that could be the threat here. What do you think?
I think you're absolutely nailed it. The one thing I will say is, you know, I lived in Europe for 4 years, so I was a European analyst. You don't see a lot of Japanese OEMs. You do see them in the U.S. So there is a brand kind of loyalty in Europe. When you go to Italy, you see Fiats. When you go to France, you see Peugeots and Renaults, right? So I do think there is some brand loyalty, but look, I mean, the Chinese BEVs are very competitive. I think they're going to be a formidable threat. Are they just going to displace the Japanese or maybe the Koreans? Maybe that happens. But make no mistake, yeah, I mean, these governments need to figure out what exactly they're going to do if they want to protect their native auto industry or just let them suffer a tough consequence.
Or just talk tough. All right, Tom, hey, we really appreciate it. Great stuff. Tom Narayan, Global Autos Analyst at RBC Capital Markets. A great entree into our next conversation because we're going to take a look at how you de-risk funding the energy transition, which is something the auto industry is in the middle of right now as well. Barclays Global Co-Head of Sustainable and Impact Investment Banking will be joining us.